Hey everybody, welcome back to the show. Another edition of 5 Question Friday. This is where I do my best to answer questions either that you asked in the chat during the live show we have every other week that I didn't get to, or perhaps that you've emailed me. So I've got 5 great questions for you. Let me show them to you. First, we're going to look at my bond portfolio. Someone asked what bonds I own, bond funds. I'll show you that. Question 2, someone asked, hey, do we really need an emergency fund? What if we just went without one? What's the big deal? 3, question about living off of interest and how does that work in terms of the safe withdrawal rate and the 4% rule and all of that. We'll talk about that. Question 4 has to do with the investment tracking spreadsheet that I have that you can use for free, and I'll show you how in a minute. But they wanted to know how to track money market funds on that spreadsheet, so we'll look at that. And then the 5th question, someone wanted to know the difference between B&D, which is we'll talk about that, but it's a bond fund, and VMFXX, which is a money market fund. And they said, hey, the money market fund has done better for quite a while than B&D. Why bother with a bond fund? Why don't we just keep all our money in a money market fund? And it's a great question. And so let's try to tackle them. So my bond portfolio, honestly, it's nothing special. The funds I use are nothing special. But here's the approach that I follow. So first I have BND. That's the ticker for a Vanguard bond fund. We've talked about a lot on this show. It's just a total bond market. So it's U.S. bonds, and it includes U.S. government bonds. It includes what they call investment grade corporate bonds. So those are bonds issued by corporations that are, that have strong financials. Think Apple, for example. And it also includes some mortgage-backed secure bonds, and that's the bond fund. So it's not a total bond fund in the same way that Vanguard's total U.S. stock market fund covers pretty much all stocks, right? Because this bond fund, which tracks a Bloomberg index, excludes at least 2 kinds of U.S. bonds. Maybe, I'm sure, well, it's really more. It excludes municipal bonds, but it also excludes high yield bonds. Those are bonds issued by corporations that, they're not teetering on the verge of bankruptcy, but maybe they're not in as good of financial health as some other companies. Doesn't include those kind of bonds. But the third kind of bond it doesn't include are TIPS, Treasury Inflation Protected Securities. So it covers a lot of bonds, a lot of types of bonds, but there are some holes. There are some gaps that it doesn't include. And so it's for that reason that I also include a TIPS fund in my bond portfolio. And if we go to that, looking at it at the Fidelity website, again, there's nothing particularly special about this bond fund. It's an intermediate term TIPS fund. It's an index fund. It's very inexpensive, 5 basis points. But there are certainly others you could use. And so my idea behind this is the B&D fund, there's no inflation protection on those bonds. You get the yield, whatever that might be, but there's no inflation protection. With TIPS, as we know, there is, and the way it protects us against inflation is that as prices rise, the principal balance of a TIPS bond also goes up. And you say, well, given that, why bother with B&D and nominal bonds? Why not just put it all in TIPS? We like the inflation protection. Well, it comes at a cost, right? And so we can look at that. You might look at the expense ratio and say, well, boy, Rob, that doesn't seem like it's very expensive. It's not much of a cost, but that's not the cost of a TIPS. So yes, TIPS give you inflation protection, but there's no free lunch. What's the cost? It's a lower yield. So we can see that the yield on this fund is 1.55 as of a couple of days ago. If we go to B&D, the yield is about 3% higher, just roughly 4.66, and that difference is the cost. So I'm paying about 3% lower yield. That's my cost for a TIPS fund. Now, that 3% is not arbitrary. First of all, it changes over time. And what that reflects is the market's view of what inflation will be, over the period of the length of time that these funds cover intermediate term bonds. And so they're saying, look, we think inflation is going to be about 3%, and that's why the TIPS fund is paying roughly 3% less today. And now you say, well, how do we know if they're right? Or maybe the market's right, maybe the market's wrong. How do we know? And that's just the kind of the point. We don't know. It could turn out that inflation is much higher than 3%, let's say over the next 5 to 10 years, in which case the tips will really pay off, right? Because I'm going to get the inflation protection. On the other hand, maybe inflation turns out to be lower than the market thinks, lower than 3%. In that case, I've accepted that lower yield, but kind of wish I hadn't. I would have just put all my money in nominal bonds, the B&D fund. And so since I don't know what inflation is going to be, I invest about half of our fixed income in B&D and half of our fixed income in the TIPS fund, and I just sort of cover my bases that way. So that's the vast majority of our fixed income, those two funds. Now, if we go back, I do have some short-term money in SGov, which many of you have emailed me about. This is a short-term, you can see 0 to 3 month Treasury bond fund. It's very inexpensive, 9 basis points. Now, I could save this 9 basis points and invest directly in T-bills, which at times I have done. But this is just convenience. This is for money that we expect to spend over the next few months. I've got money in there that I'm going to have to send to Uncle Sam with our tax payments here coming up in April. And we also have some money in there that we're going to spend on the house in the next, roughly 6 months. Now, and that's those 3 funds, that's basically my bond portfolio. Now, I will mention V-Bill. This is a new fund that Morningstar's just launched. They actually launched 2, but this is the one we'll talk about today. We can look at it briefly, but it's the same 0 to 3 month Treasury. It's actually 2 basis points cheaper. You'll notice there's no SEC yield yet, and that's because the fund was just launched. It was just launched, and so I'm keeping an eye on that fund to see how it performs, but I mentioned it again, it was just launched, so we'll see how it does. So there you go, that's my bond portfolio. Okay, question number 2. The viewer emailed me about an emergency fund and whether we really need one. And it was triggered by this article here. This is Big Earn's site, Early Retirement Now. Now, he's actually, Karsten, the Big Earn, his nickname, is going to be on the show. He's coming on. The next live show is the 24th of February, I believe. I believe that's right, 24th. And he's going to be a guest on the live show with me, and he'll be helping me answer your questions. So I hope you can join. And if you can't join, they are, of course, recorded, so you can watch them after the fact. But he's going to be on the show. I'm looking forward to that. Anyway, back to the question here. Do we really need an emergency fund? And again, based on this article. And his answer, as you can see, is no, we don't need an emergency fund. Maybe we'll talk about this when he's on the show. My take on it is this. First of all, the fundamental question is, if you have an emergency fund, how will you deal with it, right? If you have an emergency, how will you deal with it? And there were times where my wife and I didn't have much of an emergency fund at all, but I was confident that we could deal with it either with a credit card on a short-term basis or a home equity line of credit. I'm not sure I would actually recommend that today, and I'm not sure that I necessarily agree with Big Earn's perspective on no emergency fund, but I think you can get away with it for a time. The thing I would suggest is this. Think about emergencies in 2 ways. There's what I call an expense emergency, right? The car breaks down, the furnace goes out. I think those can probably be handled for a lot of people without actually having a certain amount of cash in, say, a high yield savings account. You can probably, a lot of people could probably handle that with a credit card and pay it off very, very, very quickly. But then there's also an income emergency. An income emergency is where you lose your job or you were expecting a bonus and you didn't get it. And there, I think an emergency fund can be very, very, very helpful. Now, I think what Karsten would say is, well, if you're still saving, maybe you're putting money in a Roth IRA, for example, you can always draw on that if you have to in an emergency. But barring that, you should keep it, invested in the market. And I think mathematically that makes a lot of sense. But when math and the science of personal finance meets sort of the practical day-to-day and behavioral aspects of personal finance. I think for a lot of people, there's some great comfort in having at least a couple of months worth of savings in some sort of liquid form, high yield savings account, a money market fund, that sort of thing. It's interesting, once you get into retirement, let's assume you don't have any, you're not working at all, you don't really have an income emergency. That's not really a thing at that point because you don't have an income. You're getting Social Security, maybe you're getting an annuity or a pension, and you have your retirement savings. And so one might argue, at least in my mind, that there is a stronger case for not having any emergency fund in retirement because at that point you're really just focused on an expense emergency. The irony, at least it seems to me, is that it's when folks get to retirement that they want to hold more and more and more cash. And at the end of the day, that can be a significant drain on your returns long term through retirement. Now, having said that, we tend to keep about a year's worth of living expenses in a short-term bond fund that I think would be close to cash. We do consider that part of our fixed income allocation, and that's just what we're comfortable with. So I guess at the end of the day, I think a case can be made for little or no emergency fund. I'm not sure that I'm going to be the best proponent of that approach, but tune in on February 24th because Big Earn might give you some more background on his approach to zero emergency fund. All right. Living off interest. This is a fascinating question. So the viewer said, I retired at 65, or if I retired at 65 and simply bought a 30-year treasury bond and lived entirely off the interest at, say, 5%, is that a 0% withdrawal rate according to Bill Bengen because I'm not selling principal? Or is it a 5% withdrawal rate because I'm spending the 5% in interest? This strategy feels incredibly conservative, but helpful to know if Bill would call it 0% or 5%. Fascinating question. So I think the answer is neither. A couple of things to keep in mind. First of all, Bill Bengen, and for those who don't know, he's sort of the father of the 4% rule. It's based on a paper he published, over 30 years ago, 1994. And the first thing to keep in mind is he didn't distinguish between, interest off of, your savings and dividends off your stocks versus growth in the value. He looked at it, and I think most researchers into safe withdrawal rates look at it this way as well, as total return. Interest, dividends, growth. He didn't separate out how much you were getting in interest, how much you were getting in dividends, versus how much your investments were just growing in value. He looked at it from a total return perspective, and I think most papers, academic and otherwise, look at it from a total return perspective. That's the first thing. The second thing, though, is that Bill Bengen, when he used, say, 4%, for example, in year one to determine how much you could spend. So if you had $1 million portfolio and we were following the 4% rule, you could spend $40,000 in year one. In year two, what you did was you took the $40,000 or whatever amount you're spending in year one, and you adjusted it for inflation. So in other words, the 4% only mattered to get things going, year one. Once you've used a percent, whether it's 4%, 5%, or something else, to figure out how much you can spend in your first year of retirement, once you did that calculation, that percentage, you threw it out. You never use it again. Because after year one, you base your year two spending on your year one spending plus inflation. In year three, you calculated it based on your year two spending plus inflation. That's the key point. If we go back to the viewer's question, if we imagine $1 million portfolio that earned 5% in interest, that's $50,000. In a 30-year bond, you would get $50,000 each and every year during the 30 years in this hypothetical. You'll notice there's no adjustment for inflation. You're not increasing that $50,000 each year by inflation. You're simply taking the $50,000 in interest payments you get every year and spending it. That's not the 4% rule at all. It's not any sort of constant dollar approach, which is the term used for a withdrawal strategy that adjusts the spending each year by the rate of inflation. Now, there are approaches like this where they say, hey, we're not going to adjust for inflation. We're simply going to take a percentage, let's say 5%, and every year we'll just draw 5% of whatever our balance happens to be, right? Now, the difference, though, is when you think about withdrawal strategies that just say, I'm going to take 5% every year, the analysis is usually done on a portfolio that includes stocks, not just a 30-year treasury where you're just going to get the same amount every year. Now, of course, if you truly owned a 30-year treasury bond, it's going to fluctuate in value, right? Now, you might choose not to sell it. That's fine. But as interest rates change, the value of that bond is going to change. And so a pure 5% with a strategy where you're simply going to take 5% of the value of your portfolio every year, you would see the amount you take fluctuate as the value of that bond fluctuated. So it's sort of a long way to look at it, but the short answer to this viewer's question is it's not a Bill Bengen approach at all. So I hope that makes sense. The thing that I think a practical side of this is if you were really going to just live off $50,000 a year because that's the interest that your bond was paying, or imagine it's in a CD, what's going to happen is eventually over time your purchasing power is going to go down as inflation, as prices rise. That $50,000 today is going to buy a lot more than $50,000 10 or 20 or 30 years from now will be able to buy because of inflation. Now, that doesn't necessarily mean it's a bad strategy for you, particularly if you combine it with Social Security that is adjusted for inflation. So maybe the combination of some, interest only off of some savings along with the inflation-adjusted Social Security benefits might make for a very reasonable approach to retirement spending, obviously assuming it meets your needs. So, great question. Not really a Bill Bengen approach, though. Doesn't mean it's bad. It's just not a Bill Bengen approach. All right. How to track money market funds in my investment tracking spreadsheet. So let's go to it. So this is what it looks like. Again, I'll leave a link to the article about this spreadsheet. And in that article, you'll see a link to it where you can get a copy for yourself. And if we go to, here are the holdings. So the way this spreadsheet works, a lot of these cells are automatically filled in based on the ticker that we put here. So, this is Berkshire Hathaway. But if we put NVIDIA, I think that's the NVIDIA ticker. I could be wrong. Yeah. If you put in a different ticker, it pulls in that company. You could do this with ETFs. Like we could put in VTI. Should pull in Vanguard's total market, stock market fund. It also automatically pulls in the price over here, and it should automatically, although I've had issues with this from time to time, pull in the fund expense ratio. This is set to 0. Let's see. Here we go. Let me copy this down. I'm not sure why that is. I'll have to fix that. Should pull in maybe the expense ratio. Looks like it's having trouble. The issue here is that I'm at the mercy of Google Finance functions, as you can see up here. And sometimes they don't always work. I'm not sure why it's not working here, but that's the idea. So here's the deal. With money market funds, Google doesn't track that data. By the way, Morningstar doesn't either. So like if we put in here, let's do I think it's VMFXX, which is a Vanguard fund. Let me make sure I've got the ticker right. Yeah, VMFXX. It doesn't show it. It doesn't have it. And the same is true with Google. If we put in VMFXX, it's not going to find it. So we're not going to get the name, we're not going to get the price, which then of course we don't get the change in value. So what I do for my own fund is I just hard code it, and so I clear out the Google function, and I'll just put in VMFXX for short, but I would put in the full name of the fund. And the nice thing about a money market fund is we know the price, because the price is always $1. So I'll just put in $1, I'll hard code it. And then the only thing I need to change are shares, how many shares of this fund I own, which will be equal to its balance, right? Since it's $1 a share. And I track it that way. Of course, I have to update the shares, but I have to do that anyway, right? Because Google Finance doesn't know how many shares I own of any investment. And so that's how I do it with, with a money market fund. You could do this with any kind of investment where publicly traded information is just not available, right? And so someone asked me about the TSP, and so you could do the same thing with TSP funds. You could hard code them. I suppose with TSP funds, you could also try to find a close equivalent, but I don't know how closely it would actually track. So you could do it this way, sort of a manual way, and that's what I do for money market funds. Okay, last question is a doozy. Here it is. And the long and short of it, this viewer was saying, hey, VMFXX has outperformed BND for a long time. So why shouldn't we just put all of our money in a money market fund instead of BND? It's a good question. Let me just show you. We can't really look at this in Morningstar. We can look at BND in Morningstar, but remember VMFXX, we just talked about it. They don't have data on it, but we can go to the Vanguard website. Let me pull that up now. And we're just using the Vanguard money market fund as an example. It is I think, one of the best money market funds out there. Very inexpensive. And if we go to performance, we can look at this and see, let's just look at the last 5 years. It's earned 2.49%. If we go to BND and look at performance, last 5 years, it's lost money. Goodness. The last 10 years, it's 135 BND. Do they have 10-year? Yeah, 176. It's outperformed. So for a very long time, Vanguard's Federal Money Market Fund has outperformed an intermediate term bond fund like BND. So what do we make of that? So a couple of thoughts here. We do know that long-term, think multiple decades, intermediate term bonds outperform shorter term bonds, and particularly cash, which is how I would define a money market fund. Long-term, intermediate-term bond funds or bonds do outperform. That raises a question, well, then what about what we're seeing for fairly long periods of time, last 5, 10 years? And I think there are two things at play. We do know that rates were rock bottom for quite a long time. Of course, you'll say, well, that would be true for money market funds too, right? It didn't just affect intermediate-term bond funds, correct. But what's really affected the performance of bond funds, when you look at sort of this cumulative, last 5 years, last 10 years, even maybe last 20 years, is this. 2022. When a bond fund, a conservative bond fund that usually is not all that exciting, loses 13% in 1 year, and it did it and it lost that much because, remember, rates were basically at zero and then they went up quickly, sharply. When it loses that much, that's going to affect the cumulative returns for quite some time. That's a big number for a bond fund, particularly when it's pretty difficult to see a bond fund like BND earn a positive 13% in 1 year. In fact, this is going back to 2015. The best year we had was 2019 at just under 9%. And so I think what you're seeing in the cumulative numbers is in large part driven by that really bad year in 2022. Certainly over a 5-year period. Of course, it lost a little bit of money in 2021 as well. It did have 2 years back-to-back that were quite strong, as you can see, 2019 and 2020. I think for me, the biggest, takeaway is picking an approach and sticking to it. If someone said, I'm going to go to T-bills, and that's where I'm going to keep my fixed income, I just feel comfortable there. I'm going to do that, say, through retirement, 20, 30 years. I think they'll probably have a reasonable outcome. Will it be as good as someone who says, I'm sticking with intermediate term bonds? My best guess would be no, but I also suspect the difference wouldn't be huge. Having said that, Bill Bengen actually looked at this in a 1996 paper. We can actually look it up real quick if you'll bear with me. Let's go to Mr. Bengen. Here he is. I'll show you this in just a minute. Yeah, so He looked at this, the question. He didn't look at the specific question the viewer asked, but what he looked at was, does holding cash in the form of T-bills instead of intermediate term bonds, how does that affect the safe withdrawal rate? Now, by the way, that may not be your primary concern, right? If you're only spending 1 or 2% of your savings in retirement because you just don't need to spend any more, the safe withdrawal rate, 4% versus 3.5 versus 4.5, may not be important to you. But if it is, I would recommend that you look at this paper, 1996, Asset Allocation for a Lifetime. By the way, just some background here. This paper right here was the 4% rule paper, published in 94, determining withdrawal rates using historical data. Then this was his second paper, Asset Allocation for a Lifetime. His third paper, he actually labeled Part 3. And you'd say, well, wait a minute, where's Part 1 and 2? Well, this is Part 1, even though it's not called Part 1. This is Part 2, even though it's not called Part 2. And then we get to Part 3, and there's even a Part 4. He's written many other papers too. But in any event, if we go to this, let me see what this links to the paper. Here we go. This is the paper. And he looks at this, and basically what he says, I'll link to this below the video, but I'll just summarize it for you. And this is based off memory. I didn't look at this ahead of this video, but I think I remember it correctly. He said if you want to have up to about 10% of your fixed income portfolio in cash, that's probably okay. Not going to affect the safe withdrawal rate very much. You go much above that, and the safe withdrawal rate starts to come down. Now, again, it's based on historical data. The future could be different, but I think it's at least a data point to consider as you decide what's best for you. So there you go. That's my take. Really great questions as always. Hopefully you found this helpful. I'll leave links to the different resources we've talked about below the video. If you have questions, leave them in the comments below. Do my best to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.